the largest man-made disruption to the global economy in recent human history. Markets today resuming their plunge, the Dow down about 1,000 points. The sell-off gaining steam after the White House said goods from China would be subject to a 145% tariff rate. That's higher than what Trump had said yesterday, when he said that that rate would be 125%. Essentially, markets spent yet another day trapped between what Donald Trump says he's doing and what his administration says he means when he says what he's doing. Brand new reporting by the New York Times reveals why this keeps happening and just how isolated Donald Trump is from any semblance of a policy process in his own administration. The New York Times reports this, quote, many of Trump's most senior advisors and officials were unaware of this major shift in policy until the last minute, because as recently as Wednesday morning, Trump was still indicating he was sticking to his previous plan, driving his sudden reversal, his fear that he and he alone would drive the world into an historic financial crisis. New York Times reports this, quote, the economic turmoil, particularly a rapid rise in government bond yields, caused Mr. Trump to blink on Wednesday afternoon and pause his reciprocal tariffs for most countries for the next 90 days. It left his aides scrambling to somehow try to spin the reversal as a win.
We've had more than 75 countries contact us, and I imagine after today there will be more. So it is just a processing problem.
If I could just add to what the Secretary said, many of you in the media clearly missed the art of the deal. You clearly failed to see what President Trump is doing here.
We missed the art of the deal. Okay. Stephen Miller went even further, though, than that. He said this, quote, you have been watching the greatest economic master strategy from an American president in history, end quote. Hours later, Trump admitted that it wasn't a master strategy at all. He admitted on camera that he was reversing course because of the markets.
Can you walk us through your thinking about why you decided to put a 90-day pause?
Well, I thought that people were jumping a little bit out of line. They were getting yippy, you know? They were getting a little bit yippy, a little bit afraid.
Markets were getting more than a little bit yippy, though. By Tuesday, Trump had wiped out $10 trillion in wealth in just a few short days. And it was what his team was fearing. The Times reports this, quote, behind the scenes, senior members of Trump's team had feared a financial panic that could spiral out of control and potentially devastate the economy, end quote. On Sunday, Bessent made a direct plea to Trump. Times goes on, quote, Mr. Bessent advised the president to focus on negotiating with other countries, saying Trump is the most adept negotiator there is. But he also stressed that Trump needed to articulate the end game of his plan because the markets needed more certainty. The president apparently absorbed only part of Bessent's message. On Monday morning, he drafted a Truth Social post to say talks were going to take place with countries. He changed it to say that they would negotiate. By Monday afternoon, he told reporters, quote, virtually every country wants to negotiate. There still was no coherent expression about the endgame. Did the president want to use the levies as a negotiating tactic to cut better deals for the U.S., or was he intent on leaving them in place as a blunt instrument to raise revenues and force manufacturing back to the United States? 3 days later, the answer to those questions remains unclear to everyone. When he was asked about how he would decide his next moves, particularly exemptions on tariffs, he said this, quote, instinctively, Donald Trump's manufactured volatility continuing to fuel a market crash is where we start again today with CNBC senior economics reporter Steve Leisman. Steve, what is happening?
Well, if you don't mind, I'd like to go back to my appearance on this show yesterday where I said that the announcement by the president was far less than it appeared to the market. And I think what happened is the market has come to that conclusion, that what happened was the president took off some of the reciprocal tariffs, but left a whole bunch of tariffs on and cranked up that tariff, as you correctly reported, on China to 145%. Well, what did that mean? It left us with tariffs that were not only just a little bit below where they previously had been. And I'll give you the numbers one more time here. We had tariffs of 3%. We went up to 30% under the president, and now maybe they're like 25%. So we still have the highest tariffs, or you want to call it one of the biggest tax increases in American history here. And that has not gone away. And so what happened is people lowered their forecasts, but didn't do away with their forecast for lower growth and higher inflation, which puts the Federal Reserve in this pickle here of they don't know what to do or how to respond. Nicole, what's going on broadly here, I hate to say this, is both American investors and global investors are selling America. And what does that mean? It means that everything that America produces right now in terms of financial assets are lower. Bonds are lower, the dollar is lower, and as you know, stocks are lower. You guys over there in the political department, you have an election every 2 or 4 years. We have an election every day here in the stock market, and the incumbent's been on a losing streak.
Tell me how psychologically impactful this week is in terms of the markets and the leaders and the movers seeing Donald Trump differently than they did 10 days ago.
Well, you know, you pointed out yesterday, and I took that as an interest advisedly, this notion that maybe there was some flexibility on the part of the president. And I responded to you, and we can go back and forth on this, that it is interesting. There was flexibility, but look at what it took to get him to be flexible. So I'm not sure how much solace you take from that particular development. Psychologically, well, first of all, you want to start to talk about financially. There are deep losses out there. There are potentials for margin call. And as we also discussed, there are losses and concerns within the financial system that seem to be a little bit better today. I need to report in terms of that. But there are still losses out there. And psychologically, what we're hearing is that all of this uncertainty freezes households from spending, and it freezes businesses from investing. People will figure out how to get through this if they knew what the rules are. But again, we have this 90-day problem that was going to be things negotiated. We don't know. It is maybe important. The president said that 10% across the board tariff could be negotiable. I think he said depending upon what's offered. But it is really hard to plan, hard to forecast. These forecasts aren't right always. Sometimes they're almost always wrong, but they give you a baseline to figure out where the future is going. It is very hard in a fog. I will tell you, one Fed official said, this is the kind of fog, you don't keep driving with your lights on and your wipers on. This is the kind of fog where you pull over, you put on your hazards, and you stop driving.
Well, then let's stick with the, I'm from San Francisco, so I love a good fog analogy. What happens when all the consumers do that, right? I mean, we're the consumers, and what's on the shelves at Walmart is unchanged by any of it. Maybe flexibility was a wrong word. Maybe a lack of permanence is a better way to describe any position Trump takes. But what happens when the tariffs, the policy that the markets are still reacting badly to, which keep going up? Not only did they not come down, they've gone up 3 times since Monday. What happens when the consumers weigh in by not buying things?
Well, that's a real effect. There's 2 impacts here. One is what we call the wealth effect. People will spend some percentage of their increase in wealth in the stock market. They think it's about 5 cents on the dollar. It matters less with low and poor income people. It matters a lot more with rich people who tend to drive spending in this country. So that's a direct financial effect. Then there's the sentiment numbers. The sentiment numbers can lead to declines in spending, but people can also look through it. Look, we should also count some of the things we have going for us. Still relatively low unemployment. You still have decent incomes, and those incomes over the past year have been rising faster than the inflation rate. We got a good inflation report this morning. We've had relatively good growth over the past several quarters. So we go into this turmoil in reasonably good shape. Consumers have the ability to keep spending if they want to keep spending. The trouble is when they get nervous about their jobs, if they think they're going to lose their jobs, they may stop spending, they may stop extending out on credit, and those sorts of things. So the psychological effect can have a real economic effect or financial effect.